Good afternoon, everyone. Welcome. This is a webinar on the RAD inventory assessment tool, which is a tool that HUD has released within the last few weeks to help PHAs who are considering RAD for the first time. So just as basic background, RAD allows PHAs to convert public housing properties to long-term Section 8 contracts, either a project-based voucher or a project-based rental assistance contract, in order to stabilize income and facilitate access to debt and equity financing if needed to make repairs. So the purpose of this tool is to allow PHAs to test out whether conversion makes sense, to create a financial pro forma of the property following conversion to Section 8 through RAD, including an income and expense statement, as well as to construct a sources and uses or development budget. So PHAs can think about how they could finance repairs. The tool is not meant to replace a more robust financial analysis of the property that every PHA should undertake, but instead aims to provide a quick glimpse at how the property would perform following conversion under Section 8. The tool works off of a PHA's whole portfolio. So when users use the tool, they will be selecting a PHA, and the tool will generate outputs for the PHA's entire portfolio once they enter some basic info. So let's jump over to the tool now, and I'll walk through some basics. So the tool is broken up into 4 tabs. You'll see at the bottom an instructions tab, a global inputs tab, an inventory overview tab, and a PHA list. Instructions provides some helpful information orienting users to the tool. We encourage any first-time users to read through. It's not overly dense. It just helps provide some basic information on how to use the tool. The next tab on global inputs is where users identify the PHA that they wish to analyze and confirm some basic assumptions that the tool will use. The inventory overview tab, the third tab, is really the main tab to view the output and modify the analysis as desired. And then the final tab is simply a list of all the PHAs by PHA code across the country. So users can readily find the PHA code that they're looking for to enter into the global input tab. So we'll walk through each. So starting in the global inputs tab, it just asks for some basic information, including first to identify the housing authority that you'd like to analyze. I'm going to select a Alabama Housing Authority just for the purposes of this webinar. The Fairfield Housing Authority, which the tool tells me has 2 amps, 2 properties. I'm going to hit this button already, populate data for all properties for this PHA, and a macro will run. It'll then tell me that user entry may begin. Make sure, of course, before you hit this macro button, you'll sometimes see a yellow tab at the top of your Excel, top of the Excel file, allowing you to enable contents. You'll have to hit that before you run that macro button, the populate data button. Okay, now that it has been run, this global inputs page asks for some basic information. First, whether the conversion will be to PBRA or to PBV, project-based rental assistance, or to project-based vouchers. We have information on the RAD resource desk that PHAs might find helpful in considering the differences between PBRA or PBV. It usually doesn't make a significant difference for the analysis that this tool performs, but it's still an important question for PHAs to consider. We're going to leave this one as PBRA. Then it asks for to confirm some assumptions about income and expenses. We're assuming a 3% vacancy loss, 2% bad debt loss, $120 per unit per year in other income, it is asked for an assumption on operating expenses. This one's very important. It pre-populates to 95% of what are called formula expenses, the operating fund formula expenses. So these are not the actual expenses of the property, but are rather the expenses that the operating fund by formula recognizes for each public housing AMP. A user can select this field and identify another option. They might say, let's not put a global input here, I'll put the number in on the next tab. They might say, actually, I operate a number of properties in this market that are not public housing, and I know it costs $6,000 per unit to run this property. That's what I could run. Or you can select 85% of formula expenses. So there's a number of options a user can input. For simplicity, we're going to start at 95% of formula expenses. And then we're also going to assume an ongoing contribution to the capital replacement reserve of $500 per unit per year, which is fairly typical across a lot of the transactions we see under RAD. But will end up varying by property based on the results of the capital needs assessment. The tool allows the user to enter in here a portfolio-wide rehab cost. This would probably rarely be used. We're going to leave this at 0 and instead modify this value on the next tab as we look at individual properties. But in case this is useful, there's that option. Similarly, the tool allows the user to identify a portfolio-wide financing approach. If you're going to, with the options of no new financing, financing with debt only, with 4% tax credits in debt, or 9% tax credits with debt. Again, it's rare that an entire portfolio will all be financed in the same way. So my default here is going to be no new financing, and I'll modify that field in the next tab. And finally, in this tab, the tool asks you to confirm financing terms related to any new debt, as well as for tax credit equity, which, if you're not using debt or tax credit equity are moot, but in the event that any project would, these values would be used, and then could be modified at a property level later if needed on the next tab. But generally, these are safe to assume would be portfolio-wide assumptions. So we're using a interest rate and tax credit pricing rates that are consistent with, right now, consistent with today's terms. Of course, a user should look at their local market and what's available when going into greater depth in this analysis. Okay, so we didn't change anything on this tab. We stuck with the pre-populated assumptions that are already built in. We've already hit the populate data button for AL010, the Fairfield Housing Authority. So we're ready to go to the next tab, the Inventory Overview tab. As the Global Inputs tab told us, this PHA has 2 public housing properties. I'm going to increase the size of this a little bit so folks can see a little bit better. The first property is 102 units. The second property is 196 units. Looks like these, just by the average bedroom size, have a mix of 1, 2, 3, 4 bedrooms. We'll see that in a little greater detail later on. These 2 properties happen to have the exact same RAD contract rent, $749. That's just a coincidence. Most PHA's portfolios that will have a range of RAD contract rents. So as a lot of folks know, the RAD contract rents are calculated based on public housing subsidy levels, taking into account the operating fund, the capital fund, and tenant rents. The rents that are loaded into this tool are called the FY18 RAD contract rents. So they incorporate historically strong capital fund and operating fund tenant rent levels from the fiscal year 2018, and we have, for our practice, inflated those rents by the 2019 OCAF, or Operating Cost Adjustment Factor, to preload the rents into this tool. So the rents you see here would be the rents a property would convert under if it's successfully converted under RAD this year. Here at the very top, a user would be able to enter the estimated per unit rehab cost, as well as to select the financing approach. Again, whether it's no new financing or debt or tax credit equity. I'll start with starting with the first property. We're going to assume this property is actually in really good shape. So the PHA was able to renovate it with ARA funds 10 years ago and has maintained it well. So we're going to assume no, or perhaps a very modest rehab cost of $3,000 per unit. Then looking down the income and expenses, the operating pro forma at the RAD rents of $749, that equates to, you'll see this both at a project-wide level as well as a per unit per year level. The $749 per month comes out to $89.84 per year. We deduct vacancy loss and bad debt loss based on the assumptions in the prior tab, as well as add in other income for an effective gross income of $8,655. The revenue the property will actually be earning per unit per year. You see the operating expenses that we had the starting assumption that 95% of the operating fund formula expenses entered in here. You could look at this and say, actually, let's modify this. It's not, this isn't really the right number. I've been able to operate this property more efficiently over the last few years, and it's actually closer to $6,200 per year. User could do that without any issue right here, but let's keep that number there for now. You also see the replacement reserve amount that we had assumed, $500 per year, which is probably a safe assumption to maintain here. That results in the net operating income. So the net operating income being the income left over after expenses and these liabilities have been paid of $163,000 for the project for the year, or $15.98 per unit per year. Because up above we said it's got modest needs, it's probably not going to need any new financing. There's no need to take out new debt for such modest needs, because let's say the PHA has got some reserves available, some capital funds or operating reserves available to contribute towards the property at conversion. We're not going to take any new financing, so no debt service is shown here in this row, and instead it's all cash flow. $163,000 that the property throws off each year. That's unrestricted for the PHA. Down below, you'll see just a hypothetical of what the tool calculates a first mortgage that the property could support, but it's not needing to do that. Also shows you what reserves would accumulate at $500 per unit per year over the 20 years. So as you think about the future needs of the property. On the second property, it's 196 unit property. We'd already talked about that with $749 per unit per month rents. We're going to assume for this property that the needs are higher, that they're, let's say, they're $30,000 per unit, and enter that amount in. We're going to take out financing here. Let's start assuming this might exceed what debt alone and debt with some PHA contribution of funds could contribute. So let's start testing this out as a 4% deal, and then start looking down. So same as the first property, we're looking at the income and expenses of the gross potential rents based on the RAD rents, deducting vacancy loss, bad debt loss, and other income gets you to the effective gross income for this property. Deducting further the operating expenses and the replacement reserve deposits gets us to a net operating income here of $355,000 per year. This property's got greater needs, so it's good. It plans on taking out debt in conjunction with the 4% tax credits. and here we're showing debt service, likely supportable debt service of just under $300,000 per year, which means the cash flows the property's throwing off is $59,000 per year. You'll see then below the maximum supportable first mortgage of $4.8 million, given the income and expenses of this property, which equates to just under $25,000 per unit, which is pretty good. Gets a bunch of the way there towards that $30,000 per unit rehab costs, which is important. You'll see here the important interplay between operating expenses and financing, right? That if these operating expenses or the replacement reserve deposits were higher, that's going to impact the net operating income, which will impact how much debt service the property could support, and then vice versa. If they're, or on the other hand, if those are if those amounts are actually lower, if operating expenses listed here, pre-populated here, are higher than what the property could actually be operated at, then that will increase net operating income and therefore increase the financing that would be available to support rehab. Okay, so scrolling down, we're going to move on to some of the other components of the tool that are related to this. So in section 2, it goes into greater detail on the units and the rents, and is where you can modify certain things. So here we've pre-populated all of the units in this AMP. So this first AMP was 102 units, second was 196 units, and you see the breakdown by bedrooms and what the RAD rents would be specific to each bedroom. The amount listed above the $749 was a weighted average, but that's derived from these individual the rents for each bedroom size. You'll also see here what we've pulled from PIC, from tenant certification data that the housing authorities have submitted into PIC for each property, what we believe to be a good approximation or decent approximation of the utility allowances that are at the property. And that's important because the rent that's listed here, $749, is net of any utility. So that's the contract rent. That's the actual revenue to the owner. On top of that, you would consider the not as revenue to the owner, but that would appear in a Section 8 contract. You'd see the utility allowance and the gross rent. So the $112 utility allowance is added on top of the contract rent of $749 to get an average gross rent of $860. Here, right below that, we also show how this rent compares to the fair market rent, which is largely for informational purposes, but might be relevant for PHAs that are considering alternative options such as Section 18 or streamlined voluntary conversion. A critical piece of the analysis of which tool is best is to first understand where the rents would be strongest. So here we'll say the RAD rents are actually decently close to the fair market rents, but not quite there. And so a PHA might consider other options if eligible. This tab also allows PHAs to enter other units and their rents at the site. So this could be used if it's a mixed income property and there are already other income generating units, market rate units or tax credit units at the property. This might be used if the PHA is using a blend of RAD and Section 18 and getting to a blend of RAD and project-based vouchers, and wants to reduce the number of units that are under RAD in the table above, and increase and include project-based voucher units and the rents that would be available through the regular project-based voucher program. So there's a number of ways in which this feature would be useful. Any amounts entered into here or modified into on the RAD rents table would then feed back up to the top of the tool, back to the gross potential rents, and would flow through the cash flow pro forma that's presented. So you'd be able to get a live assessment of the property's financial performance, testing out different scenarios on unit mixes. Below that, you'll see the fair market rents listed here. There's really the primary reason these are listed is to test the RAD rents against potential FMR caps. So, for example, for project-based voucher conversions, rents couldn't exceed 110% of FMR, and for project-based rental assistance conversions, rents could not exceed 120% of FMR except in certain circumstances. So we've pre-populated the table with the 2019 FMRs, and the analysis on rent caps is shown below, where you'll see what the current funding rent is, the RAD rent, and you'll see the applicable rent caps for the PBV and PBRA programs, and it'll show you if those caps had any effect. In this case, the FMRs exceed the current funding RAD rents, and so they're not capped in any way. So the RAD rents would still be unchanged at $749. Okay, we'll keep going down beyond this into Section 3, the sources and uses. So the sources and uses are listed here largely at a summary level. The uses are summarized and based on more detailed inputs and assumptions that are in Section 4 of the tool. But to give you a quick glimpse of a property, we've built in assumptions around uses based on the input the users put above on construction costs, as well as assumptions on other soft costs and other related transactional costs that are, again, found in further detail in Section 4 of the tool. So here you see, based on $3,000 a unit in rehab, that for the property comes out to $306,000. We have estimated that the related soft costs around other due diligence, doing a capital needs assessment and title and recording costs and other things like that, comes out to about $64,000. We're assuming that there are likely need to be an initial deposit to the replacement reserve of $51,000. All of this could be further modified below, but again, just to give you an initial sense, this property with modest upfront needs would have a total uses of $421,000. And then you see the sources, a table for the sources entered below. Remember, this is a property with very modest needs, not expecting any new financing. We've got a table full of a number of different financing options, but that's not in the cards for this property. Instead, just with those modest needs, the PHA's, what we see in most cases is the PHA funds that from available funds that they might already have. So I'm just gonna cover these costs by entering in same value, that $421,180 that the housing authority is putting up in from, say, the operating reserves of the property, maybe some capital funds to cover the costs. Of course, the PHA would have to make sure they've got those funds available, but it's a modest amount and likely would be covered in that way. If needed, the PHA might consider a small loan or something like that, but again, it's likely not. It's not what we see in most cases in most RAD conversions. In the looking at the property next door that we identified earlier had needs closer to $30,000 per unit, and that we first want to test out as a 4% tax credit deal. We've built in assumptions around the sources and uses going in that direction. So there would be the acquisition cost of where it's the housing authority is selling it into a tax credit partnership. That's largely going to be offset. We'll see later on by seller take-back financing, but is a largely paper cost in order to build up tax credit basis. We've got the hard cost of $30,000 per unit, plus some contingency and overhead built in. It's in greater detail in Section 4. Oh, excuse me. We've got some relocation likely entailed there, and relocation expenses. We've got greater soft costs because now you're not only doing title and recordation and capital needs assessment and environmental review, but you're also paying financing fees and covering the cost of bond issuance and other soft costs. You're covering reserves, and this is starting off with an assumption that there would be a developer fee built in. That might need to get later ratcheted down in order to cover a gap, but it starts with an assumption that the owner's earning a developer fee off of this work. The developers generating that fee. So let's see what we've got in our sources. So the first mortgage loan that was calculated above comes in at $4.8 million. We've got seller take-back financing, which is the other side of the cost of acquisition. The PHA is technically selling it into the tax credit partnership, but then contributing those funds directly back in, so it's really just a paper cost. And then the value of the tax credits that the tool estimates, it comes in at $3.7 million. Of course, this is a real rough, high-level estimate, but so far this looks pretty good. With the assumptions made so far, a property with these needs and generating this income and in this market could make this deal work, and shown by the sources and uses having a small surplus. Of course, with that surplus, you might increase the amount of work done. You might decrease the size of the first mortgage loan. There's a number of things that could be done there, but at a first glimpse, looks like this property could likely address its capital needs and stay sustainable through a RAD conversion using 4% tax credits. And the other property looks like it too does well. Obviously, it has much lower needs. PHA will get the property over to the Section 8 platform, contribute public housing funds in, over $400,000 in public housing funds in, but there's no new financing, so all cash flow will stay with the PHA. I think we saw up above. Let's just jump back to it. There you go. Cash flow of $163,000 per year that this property will throw off. In this case, we found this PHA and these two properties are likely pretty good candidates for RAD and could probably make the numbers work. Of course, as we've talked through, that'll depend on a number of variables and could be thrown off by things. What if these operating expenses are way too low and they're actually $1,000 or $2,000 more per unit? What if the rehab costs of these properties are actually found to be much higher? Could it still pencil out? What if the PHA has no capital funds or operating funds? Could it still fill in the gap of covering the expenses associated with this first property? Oftentimes these things are solvable. Sometimes they're not. But the first step is to understand, get a basic understanding of how the property will be structured financially, and then to refine the assumptions until you have greater certainty and comfort in the performance of the property. The tool has additional sections that I won't go into great detail on today. So you'll see section 4 has a greater detail on the development budget. These are all pre-populated assumptions on costs that will vary by market and by size of property and other issues, other variables. But we've filled these in just to give an initial start for the tool to generate results. You can go and modify these as desired. The tool also goes into greater detail on the sizing of the debt and on the tax credits. So you can modify the debt assumptions by property here. You can look out and say, what will be the debt service coverage in future years? Maybe the property can support, seems to have a healthy or adequate debt service coverage in year 1, but what would happen in year 15, which is often an analysis a tax credit investor will do. You can see the full calculation of how the tax credit equity was developed based on estimated value of the property using a capitalization rate method, looking at how much of the value is allocated to the building versus to the land. You can see the calculation of basis and of how that basis equates to tax credit equity. So again, we won't go into further detail on this over this webinar, but just for transparency and for if anybody wanted to modify any of these assumptions, they could. I forgot to mention at the top that the password to the tool is available in the instructions tab. We generally don't recommend people try to modify things significantly, especially cells and rows and things like that, because it will likely throw off the macros and the auto population will break. But users are free to do so if they want to for formatting reasons. Sometimes we're told that folks it's helpful to cut and paste pieces, say the income and expense statement or the sources and uses, into a separate document so that PHAs can present to their board or to others if needed to show how the property could be viable under RAD. The only other thing to point out is you'll see along most rows you'll find a blue question mark box and some hopefully helpful comments that give a little explanation and background or point you to more information on each item. It's all meant to be educational and hopefully provide helpful background. Okay, that is the extent of the presentation on the tool. I think we will turn to questions to see if there's anything folks like to ask about. Okay, so there's some questions on whether, how the rents are adjusted if you're changing the configuration of the units and other reasons. So indeed, if you, in section 2, where you can enter in different units, or if you, through the conversion, or changing a 3-bedroom unit to a 2-bedroom unit or a 2-bedroom unit to a 3-bedroom unit, the tool would automatically adjust the rental revenue based on the proposed unit size. That could also be true, of course, if you're doing a de minimis reduction of units and you're reducing units altogether. or if you're doing a de minimis reduction and then backfilling that de minimis amount with some local project-based vouchers, then you'd add those project-based vouchers into that next table of other units. So it largely covers those things. It may not cover, it likely doesn't cover every rent flexibility that's available under RAD. For folks' background, we have a separate, I think we call it a CHAP amendment and rent flexibility guide that's available on the RAD resource desk. It goes through a number of the ways in which the RAD rents might be modified. In some cases, the tool won't automatically, in most cases, the tool probably won't automatically reflect those changes. But for modeling purposes, a user could always add that amount in as other income if they expect reasonably that the property would be eligible for one of those rent adjustments. We had a question, where do we access the tool? Great question. So the tool is available on hud.gov/rad in a drop-down box that has tools in it. So this is available at hud.gov/rad and will remain available. I forgot also to mention that while the tool was rolled out early in June, we've updated it a couple of times to take care of small bugs that we found. And so the most recent version is a 6.25, is a June 25th version. So if you happen to have downloaded the tool as soon as we put it out, it's worth your while just to download a fresh version. Okay, let's see. Where is the password? The password is in the very bottom of the instructions tab. The password is RAD2. We have a question unrelated to the tool around if you initially decide to convert without any new financing, how long before would you be able to pursue financing for the property as the property ages? There's no restriction. A number of the properties that convert under RAD are in pretty good shape and don't need any new financing at this time. But if in a year or 3 years or 15 years they need to go secure some financing to address needs at that time, that's completely anticipated and is acceptable. There's a question of what if you want to calculate for an individual development within a project? That's a good point. So the tool is organized by AMPs, by the asset management projects that PHAs have identified. Sometimes we find that conversions are only entail one, that the AMP actually includes more than one project, and that PHAs often convert a portion of the AMP, say the senior high-rise and not the family townhouses that are part of the AMP. So the way to analyze that is to take out the units in Section 2 associated with the family units and only have the elderly units in the high-rise included. Yep. There's a question about what if you get certain reference errors. You can always shoot those into rad@hud.gov, and we'll see if we can, if there's some issue that we can support. Of course, if you have taken the liberty of modifying the tool, we're likely unable to help fix, as in modify the tool by using the password to actually change things. We will not be able to help, but if just in the normal course of using the tool you find errors or other issues that pop up, you're welcome to email us at rad@hud.gov. There's a question of whether the FMR rents could be put into the RAD contract rent cell. So the tool is built really centered around RAD. And if a PHA, say, wanted to use this tool to say, well, I'm going to convert 4 of my properties through RAD, but my last property I'm going to take through Section 18 under 50 units because I'll have under 50 units by that time. Can I use this tool to test out, to analyze it that way? What we'd suggest is zeroing out the units in the RAD table, again in section 2, zeroing out the units in the RAD table and entering those units in the other units table and at the FMRs or whatever the PHA determined would be the appropriate project-based voucher rents. It's a question of whether the sources of some of the data, so whether we've pre-populated data based on submitted financial statements by PHAs. No, the data here does not take into account submissions of property financial statements for each AMP. We explored that. The data came out a bit too messy to be really useful. And so we've used as our default the operating fund formula expenses, which are kind of modeled expenses that were developed for every public housing property, but that may not reflect the actual expenses of how the property is operating today. Okay, we seem to be running out of questions. Is there anyone else that wanted to submit a question or has anything else before we wrap up? Okay, well with that, thank you very much for joining. This webinar will be available on our website as well, probably right next to the tool. So if anyone needs to watch again, or if you have friends that were unable to make today's webinar, you can refer them there. We'll also send this out through a RAD blast. Thank you so much for attending, and have a wonderful day.